Welcome back to Venture Capital History, where we explore the past, present, and future of venture capital in cities across the United States. Today, we're looking into the story of Silicon Valley, California, the global epicenter of tech innovation and venture capital. Silicon Valley is synonymous with entrepreneurship, and for good reason. But how did it become the powerhouse of venture capital that it is today? To understand its rise, we have to go all the way back to the founding of Stanford University. Trace the birth of tech giants like Hewlett-Packard and Intel, and look at the early venture capitalists who saw the potential in this fledgling industry. Then, we'll analyze its current status and debate its future as the leader of the global innovation economy. Our journey begins in the late 19th century with the establishment of Stanford University in 1885. Founded by Leland and Jane Stanford in memory of their only son, Stanford University was envisioned as a place of practical learning. Located in what was then a sleepy agricultural region known as the Santa Clara Valley, the university would later play a pivotal role in transforming this region into what we now call Silicon Valley. From its inception, Stanford had an entrepreneurial spirit. The university fostered an environment that encouraged research, experimentation, and collaboration with industry. In fact, Leland Stanford himself wanted the university to teach the personal success skills needed in the world of business and industry. One critical factor in Silicon Valley's future success was the university's close ties to the emerging tech sector. Frederick Terman, the so-called father of Silicon Valley, was instrumental in this. He was an electrical engineering professor at Stanford, and he recognized early on that academic theory needed to translate into practical innovation. Terman encouraged his students to start their own companies and to stay local rather than moving to the established industrial hubs on the East Coast. One of the most famous examples of this entrepreneurial culture came in 1939, when two of Terman's students, Bill Hewlett and David Packard, founded Hewlett-Packard, or HP, in a small garage in Palo Alto. This humble beginning has become a cornerstone of the Silicon Valley narrative, the garage startup myth. Hewlett-Packard wasn't just an early success story. It helped establish a local ecosystem where innovation could thrive. The company produced a variety of electronic devices, many of which were used in World War II, further strengthening the relationship between technology and national defense, a theme that would continue to define Silicon Valley for decades. The success of HP attracted more attention to the region, leading to an influx of engineers, researchers, and academics who wanted to be part of the next big thing. The seeds of what would later become the venture capital industry were being planted. Another crucial factor in Silicon Valley's growth was its deep ties to the U.S. government, particularly during the Cold War. Following World War II, the U.S. government invested heavily in research and development, with much of the funding going to defense-related projects. Silicon Valley, with its proximity to Stanford and other key research institutions, became a natural hub for this activity. Defense contracts played a massive role in sustaining the early tech companies. Government funding for projects related to aerospace, computing, and microelectronics created an environment where technological innovation could flourish. The close relationship between the U.S. military and private companies like Fairchild Semiconductor and Lockheed Martin injected billions into the local economy, helping to turn fledgling companies into industry giants. This also set the stage for the development of the semiconductor industry, which is one of the cornerstones of Silicon Valley's legacy. And as these companies grew, they required funding. Enter the venture capitalists. The birth of Silicon Valley's venture capital ecosystem can be traced back to the 1950s with a man named Arthur Rock. In 1957, a group of 8 scientists, later known as the Traitorous Eight, left the company they were working for, Shockley Semiconductor, to form Fairchild Semiconductor. Arthur Rock was the financier behind their efforts, and his decision to back Fairchild is considered one of the first venture capital deals in Silicon Valley. Fairchild Semiconductor played a pivotal role in the rise of Silicon Valley by laying the groundwork for the semiconductor industry. Many of its employees went on to found other companies, most notably Intel, founded by Gordon Moore and Robert Noyce in 1968. But Rock wasn't just investing in technology, he was investing in people. He recognized that the key to success wasn't just in the technology itself, but in the talented individuals who could push innovation forward. This philosophy, investing in people, not just ideas, became one of the guiding principles of venture capital in Silicon Valley. By the 1970s, the pieces were in place for Silicon Valley to become the global center for venture capital. The region had top-tier universities, a pipeline of engineers and scientists, government support, and a nascent tech industry. All it needed was capital. In 1971, the modern venture capital industry was officially born with the establishment of Kleiner Perkins and Sequoia Capital, 2 of the most iconic VC firms to this day. These firms, along with others that emerged in the 1970s and 1980s, played a critical role in funding the next generation of tech companies, including Apple, Oracle, and Cisco. It was during this time that Silicon Valley began to differentiate itself from other tech hubs. The region became a magnet for talent, and the local venture capitalists were eager to fund high-risk, high-reward startups. These investors weren't just providing capital, they were providing mentorship, strategic advice, and access to networks that could help founders scale their businesses. As the personal computer revolution took off in the 1980s, Silicon Valley cemented its status as the world's leading innovation hub. Venture capital flowed into the valley, fueling rapid growth in the tech sector. By the 1990s, Silicon Valley was at the heart of the dot-com boom. Venture capital firms were pouring money into internet startups, and valuations soared. Companies like Yahoo, Netscape, and Amazon were emblematic of the era's exuberance. However, as we all know, this period also led to the infamous dot-com bust in 2000. Billions of dollars were lost, and many tech companies collapsed. But the crash didn't spell the end of Silicon Valley. It marked a turning point. The bubble burst forced investors to be more selective, and only the most resilient companies survived. Companies like Google, which was founded in 1998, would emerge stronger from the ashes of the dot-com bust, setting the stage for the next tech boom, the rise of social media, cloud computing, and mobile technology. Post-dot-com, Silicon Valley entered a new phase. The rise of Google, Facebook, and other tech giants in the early 2000s transformed the region from a place of startups to a place dominated by massive companies with global influence. Venture capital firms continued to invest heavily in these businesses, fueling their rapid growth and enabling them to dominate their respective markets. This new era also saw the rise of platforms and cloud-based services, which would go on to define much of the next 2 decades. Silicon Valley became synonymous not just with innovation, but with disruption. Companies like Uber, Airbnb, and Tesla radically reshaped entire industries. But the very success of these companies has raised questions about Silicon Valley's future. As these tech giants grow larger, they also face increasing scrutiny from regulators and the public. The tech landscape is changing, and the venture capital model that worked in the early days may need to evolve. Which brings us to the big question. Can Silicon Valley maintain its dominance as the global center for innovation and venture capital? There's no doubt that Silicon Valley has built an incredibly powerful ecosystem. Its network of entrepreneurs, engineers, venture capitalists, and universities is unparalleled. The infrastructure for creating and scaling companies is deeply ingrained. However, the future isn't guaranteed. There are several factors that could challenge Silicon Valley's continued dominance. First, the high cost of living and doing business in the region is driving some startups and investors to look elsewhere. Cities like Austin, Texas, Denver, Colorado, and even international hubs like Berlin and Tel Aviv are becoming attractive alternatives. Second, there's the increasing regulatory pressure. As tech giants grow, they face increasing scrutiny from both USI and international regulators. Concerns about monopolistic practices, data privacy, and the ethical implications of artificial intelligence are forcing many of these companies into the political spotlight. Regulation could stifle some of the innovation that has traditionally flourished in this relatively unregulated environment. Third, the rise of remote work and distributed teams, accelerated by the COVID-19 pandemic, is also changing the dynamics of where startups can thrive. Today, talent can be sourced globally, and companies don't necessarily need to be located in Silicon Valley to access the resources they need to grow. This decentralization could diminish the region's traditional dominance in favor of more distributed innovation hubs. On the other hand, Silicon Valley's ecosystem is incredibly resilient. The region's venture capital firms remain some of the largest and most influential in the world. These firms continue to attract top-tier talent and back high-growth startups across a wide range of sectors, from artificial intelligence to clean energy. Moreover, Silicon Valley's culture of risk-taking, innovation, and collaboration is hard to replicate. The relationships between venture capitalists, entrepreneurs, and technologists have been built over decades, creating a deeply interconnected network that still attracts the best and brightest from around the world. That said, we may be entering a new phase where Silicon Valley remains a dominant force, but no longer the singular center of innovation. The rise of other tech hubs, combined with evolving work trends, suggests a more distributed future for entrepreneurship and venture capital. Rather than one Silicon Valley, we might see a world with multiple innovation centers, each contributing to the global tech ecosystem in its own unique way. In conclusion, Silicon Valley's rise to global prominence wasn't an overnight success. It was the result of decades of academic innovation, government support, entrepreneurial risk-taking, and of course, venture capital. From the early days of Stanford University and the founding of Hewlett-Packard, to the explosion of tech companies in the 1970s and the rise of today's tech giants, Silicon Valley has played a pivotal role in shaping the modern world. Yet, as we look to the future, the question remains, will Silicon Valley continue to lead the way in tech innovation, or will it share the stage with other emerging tech hubs? The answer may lie in its ability to adapt to new challenges, embrace diversity in ideas and geography, and continue fostering the kind of entrepreneurial spirit that has made it what it is today. Thank you for joining us. If you enjoyed this episode, please smash the like and subscribe. See you next time, and stay well.